Today's guest is Stephen Clapham, founder of Behind the Balance Sheet and one of the best independent voices in investment analysis today. Stephen, you spent over 25 years as a professional investor, including at multi-billion-dollar hedge funds. You've built out Behind the Balance Sheet into a fantastic platform. You've written a phenomenal book, The Smart Money Method, How to Invest Like a Hedge Fund Pro. You're all over the media. You've been featured in the Financial Times, the Times, Bloomberg, Odd Lots. But more importantly than all of that, you are here today. So thank you and welcome.
Well, thanks for having me. I'm excited to talk to you, and I'm looking forward to it.
Absolutely. I mean, let's dive in. An amazing career so far. Just talk me through it. How did you get to Behind the Balance Sheet? Tell me everything that built up to that moment.
Well, how long's the podcast? Because I'm very old. No, I ended up in the city really by accident. And, I started in the South Side. Then one of my clients asked me to go and work for them. And I thought, why didn't I do this earlier? Because I really enjoyed being on the buy side. And I set up Behind the Balance Sheet as a training consultancy in 2018. I did various things in between. It was really an idea that how do you put your experience to good use?
Yeah.
Right. So training was something a friend of mine suggested, and I started off doing one-to-one coaching. I then was asked by Russell Napier, put me in touch with Stewart Investors who were looking for a forensic accounting course.
Okay.
And he said, could you build us one? And so I thought it was quite an interesting project.
Yeah.
So I went and locked myself away in the British Library for about 6 weeks. I completely blew the budget. But you know what it's like when you get interested in something.
Yeah.
And I thought, it was quite an interesting project because I'd never done anything like that before. I never built a training course before.
Yeah.
So I thought, how do you go about doing that? So I sort of researched the training courses, and then I thought, okay, so forensic accounting. I mean, I'd done a bit of forensic accounting, but I wouldn't call myself a forensic accountant. Other people called me that, but I don't really consider myself that. But the idea I had was, let's look at frauds because they're the most extreme example of companies cheating.
Yeah.
And so if you get the extreme examples, it brings it all home. It's much easier to understand. And so I studied probably 70 odd frauds, sitting in the British Library, looking at all these stuff. And I found it really, really interesting. And so I built this course, and the course has been incredibly popular. I mean, thankfully. And I mean, my clients, I don't know, I'm allowed to say all of them. I mean, some of my clients are, some of the biggest and most successful hedge funds in the world, people managing tens of billions of dollars. And so I now do 3 things. I train professional investors now to be better at analyzing financial statements, reading 10Ks and so on. I've got an online school, which is 50% professional, 50% private investors. And our main product is a course called Analyst Academy, which teaches you everything you need to become a serious investor. And we've got a professional version of that for people that are wanting to get into the industry to become an analyst. And then the third part is the podcast. So I've got a popular podcast and a Substack. But again, it's quite interesting. This was something that I didn't want to do. So Substack approached me and said, why don't you write a weekly newsletter? And I remember having the conversation with Linda Lebrun. I said to her, Linda, all these years, I've never written a weekly publication. I've never even written a monthly sector publication. I did one monthly publication for a short period to help another team. But no, I mean, it sounds like the worst possible thing. And she said, how about we pay you? Okay. And I said, how much? And so we had a conversation, and they paid me a publication advance. And I thought, let's have a go at it. And what's very funny about this is that the thing that I was dreading, I now really enjoy.
Okay.
So which is it's quite an odd thing. Once you start getting into it, of course, what I was worried about was that I would come in the Monday morning and think, oh, crikey, what am I going to write about this week? And I'd be, I thought it'd be terribly pressured. So before I started, I made a list. I think it had about 70 different topics that I could write about. And it was all listed in a spreadsheet. I don't think I've ever looked at that spreadsheet. Because I've always, you come in the morning and you think, oh, actually, you know what I'm going to write about? I know what I'm going to write about this week. So I've been writing recently about the hyperscalers CapEx, because I think people haven't really understood the full ramifications of that.
And how much of that is off balance sheet?
Yeah, well, the very interesting that, you would imagine that it's a very obvious thing. If you're a professional investor, you're a professional financial analyst, you would imagine that you would spend a lot of time reading annual reports, because there's a huge amount of information, particularly in the United States. The 10K's got a huge amount of information. Well, I'm afraid that people don't do it, right?
Well, you'd be surprised how many people on the buy side don't have a model for a company that they own a significant amount of. You'd be surprised how many, you can't really get away with it on the sell side, but on the buy side, just rely on the management relationships. It's like, oh yeah, I've spoken to them, things sound good, won't bother to read the 10K or won't bother to read the annual report. It's kind of worrying.
Particularly from doing the podcast, you learn that people have very different ways of managing money.
Yeah.
And, the people I interview in the podcast are pretty successful investors.
Yeah.
And, they have a very, very different approaches. And it's not for me to say, oh, you must have a model. I know lots of people that don't have models in all their stocks. But I do think that reading the annual report, the 10K, is kind of a basic price of entry to a stock. And I'm not saying that every private investor should read the 10K or annual report cover to cover for every company they own. But if you've got a significant position in something, it's really helpful discipline to read the annual report and try and understand the business a bit better, because at the end of the day, what you're buying is an income stream.
I've got two things to say to that. I think one is, I think there's a skill to reading annual reports, because a cynic might say that they are just an exercise in marketing a company's stock. And so you do need to read it with a critical eye. And I think two is, AI surely makes that, that price of entry, as you put it, into a stock way more affordable in time as a currency for ordinary retail investors.
Yeah, I'm kind of old-fashioned, right? So I'm not saying that, the AI can't do it for you. Maybe it can for certain people, maybe it can handle certain basic functions. I remember having a phone call with my number one client, which was the most successful hedge fund in London. I can't now remember why I called up, but I was having a chat with my counterpart, the analyst in the transport sector. And I said, so what are you up to? And he said, oh, I'm putting in the British Airways traffic figures into the model. And I said, why are you doing that? I'll send you my model. He said, I've got all the data and I can guarantee you it's all 100% accurate. And he said, no, I don't want to do that. I said, well, why not? He said, well, I want to look at the numbers. And, Mark Rubenstein wrote in his column a few weeks ago, he was talking about Claude and its ability to produce a forecast. And he made some comment. I think I made a comment in my book that I found it quite therapeutic putting the numbers in. And the reason I do it is not because I enjoy it. The reason I do it is it forces you to look at every single number.
Yep.
And what I found is that process and that discipline means I don't miss anything. But the reason that I've done that isn't because I enjoy it. The reason that I did that when I was a professional investor was that I was doing deep dive special situations research. We were taking very large positions in companies, and we didn't want to make a mistake.
I'd love to dive in a bit more on Substack. I think what strikes me is you're a planner. So you started with courses and you thought, right, I've been asked to do this course. I'm going to look at 70 frauds. It's going to take me 6 weeks. You then have Substack approach you, and even if you didn't come back to it, you put a list of topics together before putting pen to paper. Can you maybe just share a little bit about what it was like starting Substack? And what I mean by that is, how did you find your voice? How did you decide who you're writing for? And is that voice the same voice that you bring to the Behind the Balance Sheet podcast?
Well, I've got a very distinctive voice, as you can hear. But I haven't really designed anything. I've just said, what do I find interesting?
Yeah.
And it's the same with the podcast. I've never sort of gone and done any market research to say, what do you want to listen to? I just produce stuff that I want to listen to.
Yeah.
And I write stuff that I think is interesting.
And dog food.
It doesn't appeal to everyone, right? I mean, I think I'm number 75 in finance on Substack, right? So I'm not,
Well, I mean, that's nothing to be sniffed at. It's 22,000 subscribers. That's a massive achievement. And you're doing that, by producing content that you think is interesting, that you believe is relevant, eating your own dog food.
Well, I think when I started with the podcast, I had this idea that I had a really interesting, fulfilling, rewarding, financially rewarding as well, career as an investment analyst. And I thought, I'd like to inspire other young people that this is a thing worth doing. And I didn't really set out to do that with the Substack. I mean, I set out with the Substack, I thought, Substack are paying me.
Yeah.
And I better write some stuff that people will find interesting. But I didn't say, I'm going to set out to write a thing to teach beginners how to invest, because I think there's lots of people that do that and do it quite well. And I don't have any particular skill in doing that.
Yeah.
So I guess my aim was more the professional investor or the serious amateur. But, I write about quite a wide array of subjects. I mean, I've written extensively, for example, about private equity, because I thought, all this nonsense about private equity you got a couple of years ago, that, the returns were, bound to continue, and, they were all geniuses. And I wrote a piece. I remember there was a report produced by Hamilton Lane, patting themselves in the back, saying, we're all so smart. And I almost wrote a parody of it. I said, well, actually, you're not so smart, and this is what's going to happen. And the private equity, in my view, doesn't have a hope in hell of making its historical returns. And all those endowments have stuffed their funds full of private equity funds. They are going to be in serious difficulty. And the switch to private credit, I mean, we're seeing the business development companies starting to get redemptions. But the Blackstone fund had a net $1 billion of redemptions. It had $2 billion of new money. And I'm asking myself, well, who is giving them this? Because it's patently obvious. And, there's nothing new in investing, right? Bitcoin apart. But there are no new concepts in investing. And when you get a lot of capital chasing a particular sector, it usually creates overvaluation. When you get a lot of capital chasing credit, the inevitable result is that credit standards fall and defaults rise. And, the private credit market hasn't been remotely tested because we haven't had a normal economic downturn. Well, Terry Smith in my podcast said that he didn't reckon we'd had one since the 1990s because the dot-com boom and bust was a particular focus in that sector. So, maybe we're in a world where we never have a normal cyclical downturn and the central banks are all geniuses. But I can tell you that I very much doubt that.